Welcome to the Insider's Guide for Buying Your First Home. If you're looking for this webinar, you've come to the right place. If you weren't looking for this webinar, then you won't regret sticking around anyway. Before we begin, please note this disclaimer. The information presented today is general advice only. It doesn't constitute personal advice that takes your actual circumstances into consideration. Please seek professional advice before you make any binding decisions. Okay, let's get the show on the road. Hello, my name is Luke Z, and I'm a finance broker at SF Capital.
Hi, my name is Priscilla, and I'm the operations manager at SF Capital.
It's our pleasure to be hosting the webinar today, and we're happy to have you join us from your home, office, or wherever you may be. Both Priscilla and I are accredited mortgage brokers who have taken hundreds of clients through the property buying process, as well as personally going through that journey ourselves. Since we and many of our clients were first home buyers, we know the burning questions and pain points you have. And today's webinar would alleviate all of them, plus more. Despite our youthful looks, we do have over 9 years of combined experience, including 3 consecutive years of challenging markets. Starting with 2018, which was when the government cooled the housing market by tightening credit to property investors. Never seen before changes came in overnight and caused the credit crunch. During that year, we saw a major reduction in investment and interest-only lending. The next year, in 2019, we had the Hayne Royal Commission, which produced a 496-page document that listed 76 damning recommendations. The pendulum swung very far that year. It was one of the toughest times ever to get a loan. I remember the sheer level of documentation that was required, with some of our applications being hundreds of pages long. And then of course we had 2020 that brought us good old COVID-19. And I think that's enough said. So, what motivates us to push through all of these tough times? Well, it is what our happy clients say about us. We are loud and proud of this because SF stands for Service First. So I encourage you to search us up on Google and read it for yourself. Now, who is SF Capital and what do we do? We are an award-winning full-service finance broking firm, specializing in residential and commercial mortgages. We're known for getting tough loans approved, irrespective of the loan type or entity. Today, we'll be focusing on residential lending by delivering an insider's guide to buying your first home. Our insider's guide will cover 5 topics. Number 1 is why are online borrowing capacity calculators unreliable? Number 2 is all of the first home buyer benefits available and a rundown on the deposit you need. Number 3 is how to purchase using a 5% deposit without LMI or the first home loan deposit scheme. Number 4 is what to consider if and when getting help with the deposit. Number 5 is how to buy a $1 million property with only $1 of lender's mortgage insurance. We will then open the floor to questions. So please write down your questions as we go, especially because the best question selected by us today will win a $50 Uber Eats voucher. And another special treat for those who stay till the end will be a handout of our very own first home buyer cheat sheet. All right, it's time to dive into topic number 1. So why are online borrowing capacity calculators unreliable? To understand this, we need to firstly explain that the borrowing capacity calculation is a function of what you earn, being income, minus what you spend, being living expenses and any existing liabilities. These are the only 2 inputs the bank is testing when they calculate your borrowing capacity. Although a minimum deposit is required for the bank to feel comfortable with giving you the loan, the amount of deposit you have does not actually increase your borrowing capacity. it is purely based on your income and expenses. So please keep this in mind as we explore this topic further. I'd like to introduce you to John Doe, my friend John Doe, a typical first home buyer. He's 25, a young professional, and he loves a $10 Long Island at Sanctuary Bar. He earns a base salary of $75,000 excluding super. This year he got a bonus of $10,000. Last year he got a bonus of $8,000. And his only liability today is a HEX balance of $20,000. We are going to test John's borrowing capacity using an actual lender assessment calculator first, then an online calculator to compare the results. Now, if this was a cooking show, this is when I would pull a dish out from under the table and say, here's one I prepared earlier. This is a lender's actual calculator, the same one their credit team would use when they review a loan application. We are not going to reveal the bank, but those who are brand savvy might be able to tell which big yellow bank this is. The key inputs are, number one, the assessment rate. When a lender tests your borrowing capacity, they are testing your ability to repay the loan at an actual interest rate plus 2.5%. This covers you for potential rate rises during the life of the loan. In this example, we are using a rate of 2.79% as the actual rate plus 2.5%, which equals an assessment rate of 5.29%. That's there on the bottom as number one, as you can see. Input number two is income. So you'll see that there are actually two rows for income because not all income is treated equally. Joe's $75,000 base salary is included at 100%, but his bonus is the lower amount of the last 2 years and then discounted by 20%, which is what you see on the right there. So this treatment can vary also depending on lender. And number three at the top is living expenses. Lenders actually use the higher of what you declare as your living expense and a benchmark that's known as the Household Living Expense Measure, or HEM for short. This HEM benchmark scales with income. And in Joe's scenario, his declared expense of $1,900 per month is lower than the HEM of $2,000 per month for his income level. So $2,000 per month is the living expense included. Finally, the last input is existing liabilities. Joe, like most first home buyers, has HEX. The HEX repayment is based on government thresholds, which scale depending on income. His repayment is $380 per month, and this is calculated by the 5.5% threshold multiplied by his base salary plus 80% of his bonus income, which is the lower of the last 2 years. Now, if his total income wasn't captured correctly, neither would the HEX repayment, and both of those together can seriously throw off borrowing capacity. You can see down the bottom there, Joe can borrow $472,000. Okay, so the lender calculator says Joe can borrow $472,000. Now that we know what that is, what about the online calculator? Again, we're not going to name the source, but ironically, the previous big yellow bank owns this franchise brokerage. The assessment rate calculation is the first input that we look at again. And you can see this is just an arbitrary number here, but that actually varies because as a broker, we can negotiate a tailored discount, and that depends on which lender and product suits you. So if you have an arbitrary rate in here, that does not generate a reliable result. Number two is with the employment income, there is only one type of income that can be entered. So if you earn non-base income like Joe, right, this calculator is highly likely to be incorrect. But for the purpose of having an equal comparison, we've manually added 80% of Joe's lower of last 2 years bonus income to match the lender calculator. Again, we are now at living expenses. But in this example, unless I'm going blind, I don't even ask you for them. Do you see them on here? And then number 4 is the HEX. So that would go in the other loan section, which is an open field. Unless you know the correct treatment for the income, then unless you know that, you wouldn't know the HEX repayment, right? So that would also contribute to an unreliable result. But we've made it correct to make sure for comparison's sake, it is an equal comparison. All right, are you ready to see the results? Here they are. And clearly, the proof is in the pudding. Even though we matched the inputs, the online calculator was still 100,000 more than the lender calculator. Instead of wasting your time with an online calculator, please engage a broker that knows their credit policy and has access to proper tools to give you an accurate assessment. I'll now pass controls to Priscilla. She's going to take you through all of the first home buyer benefits available and how much deposit you really need.
Cool. Thanks so much, Luke. That was very insightful. So after understanding how important in getting your borrowing capacity right is, we can now switch gear a little to understand what first home buyer benefits are actually available to you and what this means in terms of deposit. So there are 4 total benefits available to first home buyers. The first one is the First Homeowners Grant. So this was one of the first grants introduced for first home buyers where you can be eligible for a grant between $10,000 to $26,000 depending on the state when buying or building a new home. Now, a new home definition, which is very important, is the first time the house has been sold and no one has ever lived in before you moved in. The second is the Home Builder Program. Or the grant, which was introduced as a response to the COVID-19 pandemic to really assist the construction industry by encouraging new homes being built or major renovations. Now, for eligible new homes, you will receive a grant of $25,000. The third is the First Home Buyer Assistance Scheme, which relates to transfer duty, or as we know it, stamp duty. So under this scheme, you will be entitled to a concessional rate or even exempt from paying stamp duty altogether. Really depends on the property value. Finally, you have the First Home Loan Deposit Scheme, which is a great government initiative to support first home buyers. This scheme really allows you to purchase your first home sooner with a minimum of 5% deposit, because up to 15% of the value will be guaranteed by the National Housing Finance and Investment Corporations. But there are limited spots available of $10,000 per financial year. Now, each state or lender will have its own limitations on the property value for each of these grants, so please make sure to consult with your mortgage broker before making a decision to buy. The best thing about this is that you're not limited to the one, but you can take advantage of all these benefits provided you are eligible, which I will share in more detail. So the question might be, how do we know if John can actually take advantage of these first home buyer benefits? There are eligible criteria which you do need to check off. So the common criteria against all these benefits include, number 1, you must be an Australian citizen or permanent resident who is an individual over the age of 18. Now, being a first home buyer, you also must live in the property for a continuous of 6 months. Obviously, in turn, not have owned or co-owned a home in Australia. Now, on top of that, there is a maximum property value for each state, which is further regulated by individual lenders with their postcode restrictions. Now, in addition to the common criteria I just mentioned, I will share with you the specific criteria which applies to each benefit. So for the first homeowners grants, really the only additional criteria is that it must be for a new property, and that's very important. So again, the definition for a new home is the first time the house has been sold and no one has ever lived in before you've moved in, okay? The next, for the Home Builder Grant, to get this $25,000 grant, one thing to point is that it must be for Australian citizens only. So what this means, if you're purchasing with somebody else, you both must be Australian citizens for this grant to apply. There is also an income threshold for single or joint applicants, which you do need to, present your tax return to evidence your current income. So for individuals, it's 125,000, and for couples, it's 200,000 per annum. Finally, there is a time frame to apply for this grant. So eligible contracts must be signed between the 4th of June 2020, which is early this year, till the end of this year, which is 31st of December 2020, with an application submitted before then as well. Now, for the First Home Buyers Assistance Program, very similar to the First Homeowners Grant, is that you're only really restricted by the value of the property. So depending on the property value, you can either get a full waiver or simply a concession. Last but not least, we do have the First Home Loan Deposit Scheme. So this is limited to certain lenders only, and you do need to reserve a spot in the scheme to get a pre-approval with the lender. Now, each lender will have its own set of rules and processes to follow. At the moment, unfortunately, all existing spots have been filled for this financial year with no lenders accepting a waitlist anymore. But the good news is that they have announced 10,000 new spots to be introduced again for new homes with a revised maximum property price cap for each state. Now, I know there is a lot to remember, but don't forget, you can always seek out help to understand whether you're eligible or not, okay? So now we know what benefits are available and if you're eligible, we can now put this into practice in understanding how much deposit you actually need by sharing 3 separate examples. So given most of our viewers here today are from New South Wales, we will focus on the grants and schemes which will affect the deposit you need to buy your first home in New South Wales. So we'll take a $600,000 established property as an example. Now we know there are other costs involved in purchasing a home. So these costs include stamp duty, which as I mentioned before, it is a state government charge on all property transactions. Then you have legal and transaction costs. So these are costs of a solicitor and other government charges to actually register your mortgage. So a $600,000 purchase then becomes, the total cost then becomes $626,000. So the bank will then calculate your borrowing amount against the purchase price. And the bank's term for your borrowing amount is loan to value ratio, or LVR. So banks will consider 80% or less to be the safest LVR. So if we work with an 80% LVR and the purchase price is $600,000, then the bank will lend you $480,000, which is simply $600,000 times 80%. Now, if the bank is lending you $480,000 and the total cost is $626,000, then the amount you need to contribute for this purchase is $146,000. But, being a first home buyer, if you are purchasing a new home, your required funds to complete will change this. So using, again, a purchase price of $600,000, part of the first home buyers scheme means that stamp duty is waived for purchases at $600,000 and below, which saves you $22,000. So your total cost is now $604,000. Again, if we work with an 80% LVR at 80% LVR, then we can calculate your contribution by taking the total cost of $604,000 less the $480,000 loan, meaning again your contribution now will be $124,000. So again, we can see an improvement to this figure of deposit already. In addition to this is that we know, as I just shared, for a new property at $600,000, this will mean you're eligible for the First Homeowners Grant and the Home Builder Grant. So this is a total of $35,000, which does result in a net contribution of $89,000 for a $600,000 purchase. Now, the reason why the First Homeowners Grant and the Home Builder Grant is below the funds to complete line is because no lender is following a uniform approach. So they may not allow you to actually use these funds as part of the purchase. Now, for first home buyers, I'm sure we all know that even $124,000 might be challenging to save up. So in the next example, I will show you how we can use a smaller deposit to purchase the same property. Now, previously I did mention that 80% is considered the safest LVR. Now, for homeowners, we can actually go to 95% LVR, increasing the loan amount from $480,000 to $570,000. But when we do that, what we call lender's mortgage insurance, or LMI, does apply. And this is a one-off fee to cover the bank in case you default on the loan. So the estimate LMI for this purchase scenario is about $24,000. This means your contribution for this purchase will be the total cost, which is $626,000, less the $570, which is the loan amount, but you need to add the LMI of $24,000, which means your total contribution is $80,000. So again, opting to pay LMI and borrow more funds, you can see again a decrease in the available deposit you need to contribute. I mean, if your question is, can we avoid paying LMI? The answer is yes. So I'll show you how this will work. So for a $600,000, again, new property, right? We know stamp duty is waived of $22,000. Now, under the first home loan deposit scheme, you can actually borrow the additional 15% without needing to pay LMI. So what this means is that all you need to do is take the total cost of $604,000 less the loan amount of $570,000, meaning your total contribution for this purchase is $34,000. Now again, on top of that, if we do apply for eligible grants of $35,000, you will see that you actually receive $1,000 in return in your home purchase. How great is that? I mean, I've never heard of it. So I mean, you can see from the initial deposit of the $146,000, which is what you needed for the $600,000 purchase, we can see how we can actually utilize all these first home buyer benefits to really only need $34,000 upfront to purchase a $600,000 home. Now, as we know, in obviously the property market, sometimes it can be challenging to find your first home at $600,000. So what I've also prepared as a final scenario is a purchase at $800,000 to demonstrate the deposit you actually need. So for an $800,000 established property purchase, you need to include transaction costs of $35,000, of which $31,000 is just stamp duty. So the total cost for this purchase is actually $835,000. Now, if again we work with a 95% LVR of the $800,000, the loan amount will be $760,000. But we need to take into account the LMI for this scenario, which would be $32,000. So again, if the bank is willing to lend you $760,000 and your total cost is $835,000, after we add LMI on top, your contribution for this purchase will be $107,000. Now, you probably guessed it, if we take again the view of it being a first new home purchase at $800,000, there are actually new government announced changes, meaning that a new $800,000 property will actually have stamp duty waived. So you actually save another $31,000. So the total cost for this purchase will now be $804,000. So similarly, the new home guarantee, which is under the first home loan deposit scheme, they have actually revised the property price caps, which also means an $800,000 purchase is now eligible for the scheme, allowing 95% LVR with no LMI. So again, if we take the total cost of $804,000 less the loan amount of $760,000, your contribution to this purchase really is only $44,000. Now this, from a normal home purchase, as we saw earlier, does show potential savings of up to $63,000. So now you should probably have a better idea on actually the deposit you need for your first home purchase. If you have any questions about this, feel free to leave a comment in the box and I'll be happy to answer. What I'll do is I'll pass it back on to Luke now.
Right, thank you for sharing that, Priscilla. That was extremely helpful, thank you. So now that you know how much deposit you need and how to purchase with a 5% deposit, either with LMI or with the first home loan deposit scheme, what if I told you there was another way to purchase with a 5% deposit? And this way does not have criteria such as a maximum taxable income, a price cap, and only 10,000 spots. This alternative, where those don't apply, is known as a family guarantee. A family guarantee is a loan structure where a guarantor's property, which would be your parents, is added as extra security for your loan. Generally, if there's no loan or only a small loan on the guarantor property, there should be enough security value for the bank to lend you 95% or even 100% of your property value without lender's mortgage insurance. Although it's important to remember, your borrowing capacity or your income and expenses need to be able to service this higher loan amount. Why the bank is happy to do this is because they would register a mortgage on the guarantor property. Therefore, the bank's security is actually your property plus the guarantor's property. However, the guaranteed amount is limited to the portion which is above 80% of your property value. So if it's a 90% loan, then it's only the 10% portion being guaranteed. Now, this does not mean you as a borrower are off the hook to make repayments. You're still responsible for repaying all of the loan day to day. In the event you cannot pay, the bank will undergo the standard process of selling your property. Then, if they are still short in recovering outstanding funds, they will turn to your guarantors to fill the balance, but only up to the guaranteed amount. Essentially, they are a last line of defense. Of course, we all owe a lot to our parents already for where we are today. And you're probably wondering, can this family guarantee be discharged eventually? The answer is yes. It is a temporary solution because once your loan becomes 80% of your property value, the guarantee is discharged. And getting there to 80% is a combination of paying down the loan as fast as possible and the market increasing in your favor. Let's use some numbers to see how this would actually play out. Say you have an 800,000 property purchase, okay? So 800,000 property purchase with a total loan of 720,000 at 90%. The blue portion is the 80% portion, which is 640,000. This is secured by your property only. The red portion is the 10% portion, which is 80,000. This is secured by your property and the guarantor property. Again, you as a borrower is responsible for the entire loan balance of 720,000. And only in the event of default would the guarantor be responsible for up to 80,000. Now let's assume two scenarios, a conservative and optimistic. A conservative scenario is where the property value does not change at all for 2 years. So the $800,000 property is still $800,000. The loan balance at which it is 80% of $800,000 is $640,000, and that is when the guarantee would be discharged. On the other hand, under an optimistic scenario where the property value grows 3% per year for 2 years, it grows to $850,000. So that means the loan balance just needs to be $680,000 for an 80% loan to value ratio, which is when the guarantee is discharged. Now, let's look at a repayment schedule to see exactly at what point in time does the loan balance reach these respective amounts. And a reminder, we are testing all of this with a $720,000 loan and an interest rate of 2.79% over a 30-year term. So if the loan started in November 2020, next month, this loan would hit the $640,000 threshold in September 2025, which is 4 years and 10 months from now. Therefore, under this conservative scenario, where only the minimum is paid and there's no capital growth at all, it takes just under 5 years to clear the guarantee. Applying the same parameters again to a optimistic scenario, the $720,000 loan, 2.79%, 30 years. Again, loan starting in November 2020, it would hit the $680,000 threshold in May 2023, which is 2 years and 6 months. Therefore, in this optimistic scenario, where again it's still the minimum repayments, but there's 3% annual capital growth for 2 years, it takes just 2.5 years to clear the guarantee. But what if you paid extra? This is where it really gets interesting. Using the same inputs, let's say my old mate John Doe drinks a few less Long Islands each week. He receives the big bonus and puts it straight into the loan. All up, that means he pays $500 extra per month and makes a one-off $10,000 repayment in year 1. Wow, do you see what's happening here, guys? We can get to that $640,000 loan balance by December 2023, which is just over 3 years away. This is quite impressive, given it was going to take 5 years if just the minimum repayments were made. So by paying off any extra amount you can afford here and there, you really accelerate how soon you can discharge the guarantee. And then you can release equity for future investment. But that's a whole other topic we won't be covering today. All right, now we know how a guarantee works, let's go through the hurdles to getting one approved. Not all banks actually offer guarantees, and the ones that do offer them on varying terms. These are the banks that do offer it, and the ones that do, these are the banks that do offer it, and they are listed here in order of most easy to most difficult, with the left being most easy, i.e. ANZ. We define them as most easy because they are happy to register a second mortgage behind any existing lender who has the first mortgage. They don't require your parents to show servicing. They also don't require proof of your parents' assets and liabilities, although it adds strength if you at least self-declare what they are. They don't require independent legal advice, but we strongly recommend this for the peace of mind of everyone involved. Then as you pan to the right, you notice each of these requirements are getting harder and harder, such as Teachers Mutual Bank or TMB not allowing a second mortgage, meaning your parents would actually have to refinance if they already had a mortgage. And then other banks actually insisting on evidence of your parents' assets and liabilities. So in conclusion, a family guarantee is a handy strategy for those who have either missed out on the first home loan deposit scheme or do not want to be bound by its limitations. But it does come with its complexities. So please seek professional advice to find out if it's right for you and your parents. Okay, it's time for us to ask you some questions. We would really appreciate your input, and the responses are anonymous. So we would like everyone to participate, and you'll have 30 seconds to answer each one. Okay, question 1 is, have you used an online borrowing capacity calculator before? Okay, give you guys 10 more seconds. Most of you have answered. All right, 3, 2, 1. We'll go on to the next question now. Question 2. How much deposit have you saved on your own so far? 30 seconds again, guys. Yeah, very good responses here, guys. Halfway through the crowd. Another 10 seconds. Come on, don't be shy. I know there's still some of you to go. All right, next question is, have you considered asking for help with your deposit in the form of a cash gift or loan from family? Ten seconds. Okay, we'll move on to the next question now. This is the second last one. Question 4. When would you like to purchase your first property by? 10 seconds. These were the questions, right? So let's go through question 1. So 89% of you have used an online calculator before. And now that you know that it's unreliable, that means 89% of you need to speak to a mortgage broker. What a staggering result. And question 2. How much deposit have you saved? I'm very impressed. That is a very, very good outcome. Over half of you has saved over 100,000, but as Priscilla showed you, you don't need as much as you really think. So even for those who haven't saved that much, you could be already ready to enter the market. And question 3 is, have you considered asking for help? Okay, this is very close down the middle here, and you'll find out more about this topic next, but that's a very interesting split. We've got almost half-half. So last question. When do you want to enter the market, basically? Oh, again, bit of an even split here, but yeah, most of you second half of next year. Okay, well, best time to enter the market was 10 years ago, but the second best time is now. Okay, thanks for your participation, everyone. We'll move on to the next topic. So did any of these surprise you? Because those questions really sets the theme for our 2 final topics. We get that it's hard to save your own deposit, amongst other things, especially all of those joining us from Sydney, where everything is just so expensive. I mean, has anyone been to Sanctuary lately? Can you believe the Long Island's are $12 now? Outrageous. Anyway, our house view is that you should take any advantage that you can get with purchasing your first home, because it is a significant life event. In addition to grants and schemes, this advantage could be a cash gift, especially if you're in the fortunate position where it is offered to you. We looked at 20 of our first home buyers and collected some interesting data that I will share with you now. Of these 20 first home buyers, 14 received a gift. The largest by quantum was 450,000. The largest by percentage of property value was 39%, and the smallest by quantum and percentage was 20,000 or 3%. The average was 11%. As you can see, a gift is not a feature of a certain geographic region. It is a universal phenomenon. So the takeaways are that property purchases nowadays are being funded by an intergenerational transfer of wealth. A gift is common, so take every advantage you can. We are aware this is a sensitive topic, as we appreciate not everyone may be in such a fortunate position. The point we're making is that it is normal to feel bad or be shy about getting help, but you're definitely not alone in that. Alright, if none of those previous strategies, grants, or schemes that we've discussed so far apply to you, then I encourage you to consider the only alternative to that and not accepting the gift. And that alternative, the only one, would be paying the lender's mortgage insurance. So let's look at what that looks like. Let's say John Doe buys a brand new $800,000 property. As an eligible first home buyer, the stamp duty would be $0. Legal and other fees would be $4,000, which makes the total cost $804,000. If John had a 10% deposit, his loan would be 90%, which is $720,000. The LMI cost is a once-off cost, and at this amount, it would be $17,700. Now, in this example, we've shown that you can add that $17,700 to the base loan of $720,000, so it is not an out-of-pocket expense. Therefore, the minimum deposit John would need is calculated as a total cost, $804,000 minus the base loan of $720,000, which is a deposit of $84,000. Now, on the other hand, if he was able to source another $80,000 deposit, he avoids this 17,700 LMI cost. And because he's borrowing less, his repayments are $412 less per month. So think about it. If you had the choice, would you rather return a favor to someone who's able to help you with $80,000 or pay almost $18,000 to an insurance company and an extra $400 per month to the bank? If and when you do decide on getting a gift or a loan, here are some other thoughts to utilize it effectively in your loan application. Number one is the bank just needs to see a gift letter signed as evidence. They do not need to see the funds in your account. They do not even need to see it in the gift giver's account. You can write your own letter, like this simple one on the right, or some banks do have their own template, like these two on the left. Secondly, if it is a loan rather than a gift, then being repayable upon the sale of property is ideal because there's no impact on your loan assessment. But if there are repayment terms, that is still okay. We just need to include them in your loan application, although it does reduce the amount you can borrow. And that's all there is to it. It really isn't as intimidating as some people make it out to be. Okay, so I hope everyone is still with us because it's time to move on to the last topic before we go into question time. The last topic is how to buy a $1 million property with $1 of LMI. When I first heard this, it sounded almost too good to be true. But really, it is good and it is true. If nothing presented so far appeals to you, we are confident that this will. St. George Bank is reducing the cost of LMI to $1 for first home buyers with a maximum loan amount of $850,000 or a purchase price of up to $1 million. A first home buyer is just someone who doesn't own property today. And a special tip for joint applicants is that means only one of you is required to fit the definition. This offer is on now. It can be withdrawn at any time because there's no set end date. It is a very special offer, and we believe St. George is catering for first home buyers aiming at a higher price point. I also believe it's because their competitors CBA and NAB have first home loan deposit scheme spots, whereas they don't. But how material is the saving anyway? Let's use actual numbers to look at this saving. So using a $1 million purchase as the example, the total cost would be $1,045,000 after paying stamp duty and other fees. If we use the maximum loan to value ratio under this offer of 85%, the loan would be $850,000. So your deposit required would be $195,000. So normally under this kind of scenario, your LMI would cost $11,000. However, if it's reduced to $1, then you are saving $10,999 on LMI and $46 per month on repayments because you're borrowing less. Even for a first home buyer aiming at a higher price point, an extra $11,000 can go a long way to cover other upfront costs like furniture, appliances, and insurance, and so on. Okay, now before we conclude, as promised to round out our Insider's Guide, we are going to give you a practical tool, which is a first home buyer's cheat sheet. How you use this is by first identifying from the top row the price range you're aiming for. If you're not sure, a starting point would be searching on domain and real estate, the ideal suburb and property type, so that you have an idea. Then you work your way down the left column, which tells you which first home buyer schemes and grants would apply. And the potential loan strategy is also there, so that you can see how you can minimize the deposit required. Please click on the handout pop-up. Well, it's on the right under the control panel, and you can download it feel free to share it with your friends. All right, here we go. This is the summary of today's webinar. The key takeaways are: number 1, use a broker to assess your borrowing capacity. Number 2, you need less deposit than you think. And number 3, don't forget about family guarantee. Number 4, take advantage of every advantage you can get. Number 5, there are special offers at higher price points too. We will now open the floor to questions. Don't forget, there's $50 Uber Eats voucher up for grabs. All right, please pop them in the chat box for us. I'm back now. All right, thank you for your questions. So we're gonna go through the top ones and then answer them first and then tell you our best pick. So first question's from Omar, and it's, is all LMI payable upfront? So yes, it's a one-off cost payable upfront. However, there's 2 ways you can pay it. You can pay it from your deposit, or you can add it to the loan. So you are borrowing to pay it off over the life of the loan. So that's how you do that. And then the second question is from Graciela.
So the question is, can you please remind us which of the grants and schemes are not just for basically permanent residents? So the 2 that is applicable for permanent residents basically is the first homeowners grant and the stamp duty concessional waiver. So those 2 are applicable to you if you're a PR.
So just to rehash, if you're a permanent resident, right, you can get the first homeowners grant, which is that $10,000.
Yeah.
And you can get the first home buyer's assistance scheme, which is the stamp duty concession or exemption, depending on price point. Yeah. All right. And then I think we have one more question here.
Yep. Which is, if benefiting from the first home loan deposit scheme, will that mean a higher monthly repayment? What is the difference between monthly repayments with and without any of the schemes? So for the first home loan deposit scheme, because you are borrowing more and producing less of a deposit, the monthly repayments will be higher. So in that scenario, yes, the monthly payments will be higher because you're contributing less towards the purchase. So what was the second one between?
Yep, that's
Yeah,
it.
that's
So
basically it.
yeah, the more you borrow, the less you put in as a deposit. So
The higher the repayments.
that's right, the higher repayments go. So those are the top questions. So thank you for asking them. And we're going to announce the winner now. Oh, it is Graciela.
Congratulations! Great questions.
You will have your Uber Eats voucher in your email shortly. Okay. All right, so if anyone found today's webinar useful or helpful, please let us know. If you have any further questions, please call us or email us or use these links to schedule a time. Thank you for your attention and have a great weekend ahead, everyone. Bye-bye.
Thank you.